Hey everyone, let me be straight with you. This market has been one of the wildest I've ever seen. Typically, I let the numbers do the talking, but right now things are moving so fast that I had to speak up. In just 90 days, the sentiment has swung completely, from people bracing for a stock market crash to now calling this a full-on bubble. And believe it or not, we're just getting started. Even though markets have soared to record highs, something big is happening underneath. The US dollar is quietly slipping toward its largest drop since 1986. Meanwhile, for the first time in decades, international stocks are outperforming US equities. And as of August 1st, new tariffs are back in play. That's why today we need to break this all down. What's really happening, why the Federal Reserve held off on rate cuts, what it means for your money, and what you can do right now to protect yourself. Like it or not, this is going to be a bumpy ride. But before we dive in, if you find these breaking news updates helpful, it really supports the channel if you hit that like button or subscribe if you haven't already. Yeah, it sounds cliche. I get it, but it really helps. And as a thank you for doing that, now before we explore the markets or what Jerome Powell just said about possibly stepping down, let's talk about Trump's top priority, slashing interest rates. Over the last year, there's been massive political pressure to cut rates to stimulate the economy. And in the middle of all this, Powell has taken some heavy hits. He's been called everything from stupid and fool to low IQ and too late. Still, he's sticking to his mission, hold rates high enough to avoid another inflation spike. Here's where it gets interesting. So far, tariffs have barely made a dent in inflation. According to CNN, prices rose just 2.4% last month, slightly above April's 2.3% and still the lowest since February 2021. Powell explained this by pointing out that retailers are still burning through inventory they got before the tariffs were introduced. That means inflation from tariffs is likely still coming, just not yet. Now let's look at why Trump might be backing off firing Powell, and why people believe we're entering another asset bubble. The root cause? A sharply weakening US dollar. Not to sound dramatic, but the US dollar just had its worst start to a year since 1973. Every day, more debt piles up, more money is printed, and the price of everything else inflates. Think about this. In the early 70s, the dollar was tied to gold at $35 Oz. Back then, minimum wage brought in $52 a week, enough to buy 1.5 ounces of gold. Today, you'd need to earn $4,800 a week to buy the same amount of gold, which now trades above $3,300 Oz. The dollar's buying power has collapsed. Why? Two main reasons. Massive money printing. The U.S. national debt just crossed $37 trillion and could top $56 trillion in the next 10 years. The only options left are to keep printing or hope inflation makes today's debt feel like pocket change. Political uncertainty. Fewer countries want to buy U.S. debt, partly due to tariffs and rising government borrowing. A recent poll showed 70% of global investors are avoiding the dollar due to geopolitical risks, up from 31% last year. And this leads us to Bitcoin. Billionaire Tim Draper argues that Bitcoin is quickly becoming a global safe haven. With distrust in traditional systems growing, people are turning to decentralized assets. Draper believes this will hit a tipping point by 2035. In fact, 65% of investors now say they plan to invest in digital assets, up sharply from just 16% currently holding any. Financial advisors are paying attention too. Nearly 50% say they'll start recommending crypto to their clients within the next year. Of course, there are risks. Bitcoin's price is volatile, and the US dollar is still backed by the full faith of the federal government. But falling rates could make the dollar less attractive globally, and that strengthens the case for alternatives like crypto. What Jerome Powell just announced, and what this all means for stocks and real estate, starting with the stock market. Objectively, things have been on fire. The S&P 500 is already up 7% this year, hitting new highs despite the occasional dip. Some analysts are calling this a bubble. Technically speaking, the Nasdaq has now gone 60 consecutive trading days without closing below its 20-day moving average, the second longest streak ever. The last time this happened was in 1999, just before the dot-com crash. Plus, the S&P 500 is trading at 26 times forward earnings, much higher than its historical average of 18. Meme stocks are surging again. AI mania is everywhere. Some strategists argue it's worse than the 90s tech bubble. Still, it's not all bad news. In 1999, Cisco traded at 200x earnings. Nvidia today trades at just 40x. So while valuations are stretched, they're not insane. And in fact, rising concentration in top-performing companies has historically led to higher returns, not lower. Looking ahead, the predictions vary. BlackRock says trillions are still sitting in short-term treasuries, waiting to be invested. Morgan Stanley has a 2026 target of 7,000 on the S&P 500. Goldman Sachs sees 6,600. Bottom line? All-time highs aren't always bad. Historically, they tend to lead to even more highs over time. But this boom will affect other markets too, especially housing. There's a bit of relief for buyers. Even with mortgage rates above 6%, home prices have mostly flattened in 2025. CoreLogic reports a 1 to 2% national increase, which is basically a real-term decline after adjusting for inflation. Some cities, Cleveland, Louisville, Hartford, are still seeing 4% plus gains due to affordability. But others, Austin, Miami, Dallas, have dropped 3 to 6% as demand cools post-pandemic. Cape Coral is even priced below the national median after 2 red-hot years. Redfin says we're on track for just 4.1 million home sales this year, one of the lowest volumes in 10 years. Inventory is also rising, up 17% YY, and homes are taking longer to sell, 19 days on average versus 11 in 2023. So what happens next? Zillow predicts prices could drop 2% in the next 6 months. CoreLogic, on the other hand, expects a 4% increase over the next year. But remember, past forecasts haven't exactly been perfect. Here's what I've personally seen in real estate since 2008. Sellers are listing at unrealistic prices hoping for bidding wars, but they're not getting them. Some list just to see what happens, knowing they can afford to sit tight with their 2.8% mortgage rate. That gives buyers a rare edge. Price cuts are happening on 25% of listings, and 1 in 7 homes are falling out of escrow. So if you're shopping for a home, be patient. The power is slowly shifting back to you. Now to the part you've been waiting for, Jerome Powell and interest rates. Just a few hours ago, the Fed decided, again, to delay rate cuts, at least until their September meeting. Why? They're worried about the effects of new tariffs, sticky inflation, and a strong labor market. So unless the economy weakens significantly, no rate cuts for now. The market is betting the first cut could come on September 17th, but that same bet has been wrong before. Usually the Fed gives the market some advance notice, so if a cut is coming, expect signs about a week in advance. As for my personal view, when meme stocks and altcoins suddenly skyrocket, I get cautious. That usually signals overexcitement and a pending pullback. But I also believe the outlook is optimistic for more trade deals and eventually rate cuts. Once Trump appoints a new Fed chair in May 2026, policy could shift quickly. Until then, my approach remains unchanged. I dollar cost average into broad index funds consistently, regardless of market timing. I don't believe in predicting the top or bottom. Statistically, that strategy underperforms over time. So tune out the noise, make a plan, stick to it, and let compounding do the work. And as always, if you made it this far, thank you. Drop a comment down below. I'll try my best to reply to as many of you as I can. Don't forget to like and subscribe, and I'll see you in the next one.